In this video, we're going to be using exercise 9-2 to demonstrate how to calculate activity variances. In this exercise, we have a company called Air Meals, and we have been given their planning budget. In December, 21,000 meals were actually served. So we can see that the planning budget was planned based upon 20,000 meals. But the actual meals served was 21,000. We're going to use the same formulas used in the planning budget to calculate a flexible budget. So for example, revenue is calculated at $3.80 per meal. If we multiply that by 21,000 meals, you get revenue on the flexible budget of $79,800. When you compare that $79,800 in the flexible budget to the $76,000 in the planning budget, you can see that revenues are higher. When revenues are higher, that's a favorable variance, and they're higher by $3,800. It's called an activity variance because we can say that this variance is caused by the level activity. Since the number of meals served is higher, the revenue is also higher. So that's an activity variance of $38,000. It's favorable because the flexible budget, based upon the actual amounts, is higher than the planning budget. Continue through and you have $2.30 per meal. That's $48,300. You have a fixed amount of $6,400 plus 25 cents per meal for wages and salaries. That's $11,650. You have utilities with a fixed amount of $2,100 and a variable rate of 5 cents per meal. That's $3,150. Facility rent is fixed at $3,800. Insurance is fixed at $2,600. And the miscellaneous component is $700 fixed, 10 cents per meal, which comes out to $2,800. For each one of these items in the flexible budget, which is based upon actual meals, we will compare it to the planning budget, which was based upon 20,000 meals. We can see that our raw materials are higher than planned. They're higher by $2,300. That is unfavorable because in the flexible budget, the expense is higher. Be careful, unfavorable does not mean good or bad here. It just means more or less. Unfavorable expenses means more expenses. Favorable expenses means less expenses. Wages and salaries, $250 more. Unfavorable because it's more expense, not because it's good or bad. Utilities, $50 higher. Unfavorable because it's more expense. Facility rent, no variance. Insurance, no variance. And miscellaneous expense, $100 higher, so that's unfavorable. When you calculate total expenses, we have total expenses of $2,700. Compare that to revenue of $3,800, and we have net operating income variance of $1,100. You could also go horizontally and look at the total expenses on the flexible budget, compare that to actual. Look at the net operating income on the flexible budget and compare that to actual. Compare both of those to the planning budget. Compare those to the planning budget. If your expenses are higher, that's unfavorable. Not good, not bad, just higher. If your net operating income is higher, that's favorable. This is really the number we're most concerned about, is the net operating income. We would expect all of our expenses to be higher. Why? Because we have a higher activity level. That doesn't mean that it's good or it's bad. It just means that your expenses are higher because you have a higher activity level. We would expect our revenues to be higher at a higher activity level. Doesn't mean it's good or bad, it just means you have more revenues. When you look at the net operating income, you can look at how much more revenue we have compared to how much more expense we have. This $1,100 favorable variance means that our net operating income goes up based upon the increase in meals. Once again, there's no one particular item on here that we can be concerned about or happy about. We can't look at this in a vacuum. We have to just talk about what we're talking about. Don't make any assumptions. And we can say that revenues are an activity variance of 3,800. They went up 3,800 when you compare plan to flexible because of a higher activity level. Net operating income went up 1,100. It went up because of a higher activity level. We still don't know if that's good. We still don't know if that's bad. We're going to have to compare our actual results to our flexible budget. Here, with 20,000 meals on the planning budget and 21,000 meals on the flexible budget, these variants largely mean nothing because this is apples to oranges comparisons. When we compare flexible to actual expenses and revenues, we'll be doing an apple-to-apple comparison because we'll be using the same activity level. That's the whole reason we do the flexible budget, is so that eventually we can compare the flexible budget to the actual budget.